For decades, the US-China economic partnership fueled global growth. China made, America bought, and Chinese capital kept US markets humming. That era is ending. In a historic move, Chinese entities have pulled $170 billion from US markets, a record-breaking withdrawal. This isn't a minor adjustment, it's a seismic shift signaling the unraveling of deep economic ties. The reasons? Escalating trade disputes, US sanctions on Chinese tech, and Washington's growing restrictions on Chinese investment. Beijing is now de-risking, pulling back to protect its assets and economic sovereignty. The result? The age of hyper-globalization is over. Friction, barriers, and realignment are replacing the smooth flow of goods and capital. This isn't just a US-China spat, it's a global economic reset. From American factories to Asian ports, the ripple effects will be felt everywhere. The world is entering a new era of uncertainty and fragmentation. What's driving this split? Geopolitical rivalry and economic stress on both sides. US tariffs and export controls have made Chinese goods pricier and targeted China's tech sector. At home, China faces a property crisis, rising youth unemployment, and a slowing economy, forcing it to pull capital back. Washington's new rules and CFIUS reviews have chilled Chinese investment, especially in sensitive sectors. The 2025 America First investment policy formalized these barriers, fast-tracking allied investment and sidelining China. In response, China is not just pulling out of US stocks and bonds, it's cutting its US debt holdings to reduce vulnerability. Meanwhile, the US is reshoring manufacturing with the CHIPS Act and Inflation Reduction Act, offering billions to bring production home. Both nations are recalibrating, seeking security over interdependence. The era of easy cross-border investment is over. The global trade landscape is being redrawn in real time. The decoupling is reshaping corporate strategy worldwide. US companies are diversifying away from China, building new supply chains in India, Vietnam, and beyond. Apple is expanding in India and Vietnam, HP and Dell are shifting production to Thailand and Mexico. Even toy giants like Hasbro and Mattel are moving operations to Vietnam and India. The China Plus One strategy is now standard. Companies keep some operations in China but build resilience elsewhere. Mexico is booming as a nearshoring hub, attracting automakers like Ford, GM, and Tesla. In Asia, Vietnam and India are rising as manufacturing powerhouses, while Malaysia, Indonesia, and Eastern Europe compete for new investment. The global map of production is being redrawn, with new winners emerging. The world's supply chains are no longer China-centric. This shift brings real costs for the US economy. The loss of $170 billion in Chinese capital means less funding for innovation and higher borrowing costs. Small businesses and startups that relied on Chinese investment now face tighter credit and slower growth. As China buys fewer US Treasury bonds, interest rates could rise, making mortgages, car loans, and credit card debt more expensive for Americans. Untangling from China's vast manufacturing ecosystem is complex and costly. No single country can match China's scale and efficiency, leading to fractured logistics and higher prices for consumers. New manufacturing hubs like Vietnam, India, and Mexico face their own challenges, strained infrastructure, regulatory hurdles, and security issues. The transition is anything but smooth. Full decoupling is likely impossible, but the pain of adjustment is real. The US must adapt to a more expensive, less predictable global economy. The US-China breakup brings risk, higher prices, disrupted supply chains, and financial uncertainty. But it's also a chance for American renewal. Reshoring, backed by policies like the CHIPS Act, could revive US industry and create high-tech jobs. Friendshoring, building supply chains with trusted allies, offers stability and shared prosperity. By strengthening ties with Mexico, Vietnam, India, and Europe, the US can build a more resilient economic network. The challenge: manage short-term pain while seizing long-term opportunity. With smart investment in infrastructure, workforce, and alliances, America can emerge stronger and more secure. The future will be turbulent, but it's a chance to reinvent and lead in a new global order.